investors are now selling off software stocks because they believe that AI will commoditize code and replace human workers. This SaaS apocalypse narrative has driven valuations down significantly, so much so that many software companies are now cheaper than traditional retailers. For example, while Microsoft trades at just 25 times PE, Walmart is trading at 45 times. This is despite Microsoft having a much higher growth rate. In this video, I'm going to share 5 software companies that defy this narrative. These are the stocks that have been unfairly punished, and yet they have business models that are almost impossible to disrupt. So to kick things off, we have Microsoft. Microsoft is the world's largest software maker and is essentially the operating system for modern businesses. Whether it is personal computers, cloud storage, or the office tools that we use every day, Microsoft is everywhere. It operates as a leading hyperscaler in cloud computing alongside AWS and in productivity software alongside Google. Microsoft has a long track record as a steady and consistent compounder, a company that can reliably grow its earnings year after year. Rather than being disrupted, Microsoft is capturing the value of the AI shift. In the most recent quarter, Azure and other cloud services revenue grew by 39% while outpacing major competitors. Likewise, the adoption of Copilot is accelerating, with 15 million paid seats now active and 90% of the Fortune 500 companies already using the service. The biggest concern for Microsoft today, however, is its massive capital expenditure. In Q2 of fiscal 2026 alone, Microsoft's capex hit $37.5 billion, driven almost entirely by AI infrastructure demands. But more importantly, reports indicate that 45% of Microsoft's massive commercial backlog is now tied directly to OpenAI. This creates a concentration risk, where Microsoft is spending billions of dollars today to build capacity for a single customer who accounts for nearly half of their future committed revenue. So the danger is that if OpenAI growth ever stalls, or if they seek out infrastructure from elsewhere, Microsoft could be left with expensive, specialized data centers with no primary tenants to fill them. In terms of valuation, if we assume a 15% earnings per share growth rate over the next 10 years, Microsoft is still trading at a 16% premium from its intrinsic value. However, in recent years, Microsoft trades at a price to free cash flow of between 40 times to 55 times. Currently, due to the recent pullback, it is trading closer to its lower range of 38 times. In relative terms, this represents a discount rarely seen for a company with such a significant moat. Quick pause, eToro Singapore is currently running one of the strongest welcome promotions in the market. New users can receive up to $500 worth of free stock rewards. Simply sign up via my link, deposit at least $200 by 28 February 2026, maintain your funds for 90 days while completing one buy trade, and you'll receive at least $10 in rewards, with the chance to unlock much more. eToro charges one of the lowest fees out there. For stock trades on most markets, eToro charges a flat $1 per trade and $2 for markets like Hong Kong and Australia. On top of that, ETF trades on eToro are commission-free. This makes it one of the cheapest platforms in Singapore right now. So if you are interested, sign up using my link to unlock the full promotion. Moving on, we have Constellation Software. Constellation is often called the Berkshire Hathaway of tech. While most companies focus on building their own products, Constellation's strategy is to acquire hundreds of small, stable software companies that serve niche industries, such as software for library management, public transit, or golf courses. Constellation continues to deploy hundreds of millions of dollars into acquisitions, with the acquisitions driving revenue growth of about 16% in recent quarters. Because these systems manage physical, real-world operations in specialized markets, they are highly resistant to being replaced by AI. For example, a city bus service is unlikely to swap its core scheduling software for an unproven AI agent. Similarly, a water utility company won't replace a 20-year-old billing system with an AI chatbot that might make mistakes. Because the cost of failure is so high, it creates a massive barrier for customers wanting to switch, especially for mission-critical tasks. At the same time, Constellation is also using AI to improve the performance of its portfolio of over 1,000 companies. By automating and support tasks within these small subsidiaries, they can further widen profit margins without needing to raise prices. While Constellation has an incredible track record so far, the primary concern for the company is that AI is lowering the barrier to entry for creating software. So the risk is that some customers, especially in the less critical niches, could eventually build their own in-house software. Beyond the AI threats, Constellation is also facing a structural hurdle. The organic growth of the company sits in the low single digits at around 3 to 5%. So, to maintain its double-digit revenue growth, Constellation must constantly find and acquire new businesses, something which is becoming harder and harder as the companies grow larger. In terms of valuation, the stock still carries a premium. If we assume an 18% EPS growth rate over the next 10 years, the company is still trading above its intrinsic fair value. However, after its recent pullback, the stock is now trading at a much lower price to free cash flow of 14.5 times, making it one of the cheapest valuation points in history. Next, we have CrowdStrike. CrowdStrike is a cybersecurity company. CrowdStrike protects devices like laptops, servers, and cloud workloads from cyber attacks. As AI lowers the barrier for cybercriminals to launch sophisticated attacks, the necessity for an AI-driven defense will only continue to grow. This is reflected in their revenue growth, which has consistently stayed at around the range of 20% in recent quarters, as companies prioritize protecting their data at all costs. Likewise, CrowdStrike's annual recurring revenue has also surged by 23%, reaching over $4.9 billion. And despite the high-profile outage in 2024, CrowdStrike's gross retention rate remains exceptional at 97%. Customers are increasingly consolidating their security spending with CrowdStrike, with 49% of clients now utilizing 6 or more modules. This shows that the platform is incredibly sticky and deeply embedded within the enterprise systems. While CrowdStrike is considered the leader in endpoint protection, the primary bear case revolves around intense competition. Specifically, Microsoft poses the most significant threat. As an entity that's already embedded in corporate IT, Microsoft can bundle good enough security into existing contracts at a minimal cost. Similarly, rivals such as Palo Alto Networks, Fortinet, and SentinelOne are aggressively expanding their own integrated platforms. This creates a platform war that can force CrowdStrike to spend more on innovation just to maintain its market share. As for valuation, despite the recent pullback, CrowdStrike still currently trades at around 90 times price to free cash flow, which makes it expensive by historical standards. Even if you assume a robust 20% earnings per share growth rate, the stock continues to trade well above its intrinsic fair value. However, CrowdStrike is in a unique position in this agentic AI era. While competitors are often busy putting together different acquisitions, CrowdStrike's single-agent architecture allows it to deploy AI-driven defense much faster and more reliably. So, for investors, the question isn't whether CrowdStrike is expensive or not. It is whether you are willing to pay a best-in-class premium for the most mission-critical platform in the sector. Next, we have ServiceNow. ServiceNow provides enterprise cloud computing solutions that define, manage, and automate essential business workflow. Management and analysts often refer to ServiceNow as a class of one because it operates as a unique AI-powered platform for business transformation, with no direct competitor that matches its scale and breadth. While companies like Atlassian compete in developer tools and legacy players like BMC compete in IT ticketing, there's no other single platform that combines IT, HR, customer service, and creator workflows on a single cohesive data model. ServiceNow revenue growth has been remarkably consistent and is still growing at over 20+% pace. The company currently dominates close to 40% in the IT service management market, effectively serving as the operating system for modern enterprise. ServiceNow is proving that AI agents are an enhancement rather than a replacement. Their Now Assist AI product is the fastest growing new product in company history, with net new contract value doubling recently. The company serves 85% of the Fortune 500. Subscription revenue grew 21% recently, while defying the broader software industry slowdown. The primary concern for the company is its seat dilution. The fear is that if AI agents make IT support staff significantly more efficient, corporations may eventually require fewer licenses. However, this concern may be overblown. ServiceNow is actively pivoting its monetization strategy towards the work performed rather than just the worker. By introducing Pro Plus tiers, which command a significant premium for AI features, the company can increase revenue even if the total seats count remains flat. As for valuation, ServiceNow has historically traded at a rich range of 40 times to 90 times price to free cash flow. However, following the recent market sell-off, it is now trading closer to 24 times price to free cash flow. This represents a multi-year low for the company. If ServiceNow can sustain an EPS growth rate of 20% over the next decade, this means that it is currently trading very close to its intrinsic fair value. Finally, we arrive at a company that arguably pioneered the SaaS revolution. Salesforce is the global leader in customer relationship management software. And because they provide a comprehensive 360-degree service spanning CRM, data cloud, integrations, and Slack, Salesforce is deeply integrated within large enterprises. For modern sales teams, the common rule is that if data isn't in Salesforce, it doesn't exist. Moving this sensitive information to a generic large language model is both risky and legally complex, and this secures Salesforce's position as the essential custodian of customer truth. Over the years, the company has matured into a reliable cash cow, significantly increasing its operating cash flow while allowing for aggressive share buybacks. And recently, Salesforce is pivoting to its agent force model, which consists of autonomous AI agents. These agents are able to do stuff such as independently analyze data, make decisions, and execute complex workflows without human intervention. This new platform recently saw a staggering 330% growth in annual recurring revenue, reaching over $540 million in just its first few quarters. The primary concern here is again seat dilution. Since Salesforce's core revenue comes from selling expensive licenses, the fear is that if Agentforce can handle customer tickets more efficiently, companies might reduce their headcounts and this might impact Salesforce's seat-based revenue. While this is a significant risk, Salesforce is hedging against it with a new hybrid pricing model. Instead of purely charging per human seat, Salesforce now charges $2 per AI conversation. This allows them to capture revenue from the digital labor that replaces human labor. While a $2 fee per conversation might sound steep at first, it represents a massive bargain for large enterprises. A typical human-handled support interaction can cost a company anywhere from $5 to $15 when factoring in salary, benefits, and overhead. By comparison, $2 for a fully resolved AI conversation offers an immediate 60 to 80% cost reduction while providing 24/7 scalability. Additionally, their agentic enterprise license agreement bundles AI consumption with standard seats, which establishes a stable revenue floor for the company. Besides this, another risk for the company is that smaller AI-first CRM startups like TextApp or Observe can do most of what Salesforce can do, at a fraction of the price. However, for large organizations that prioritize logic safety, intellectual property protection, and data security above all else, they are unlikely to switch over just because a cheaper alternative came along. In terms of valuation, Salesforce is trading at a 10-year low. Its price to free cash flow is currently hovering at around 14 times. These levels are typically reserved for slow growth utility companies rather than dominant software monopolies. Analysts estimate Salesforce to be able to grow its EPS by 18% over the long term. However, even if you assume a more conservative growth rate of 12%, the stock is still trading well below its intrinsic value. This implies a massive potential upside if the company simply returns to its historical mean valuation. In short, the SaaS apocalypse narrative has created a rare opportunity to buy high-quality, cash-generative businesses at valuations we haven't seen in years. Whether these companies are capturing the AI shift like Microsoft or defensive niche players like Constellation, they all possess moats that are much harder to penetrate than the market currently believes. Anyway, that's all for this video. Hope you found it useful. Like, share, and subscribe as I'll be posting new videos every week.